Discover which ETF delivers more reliable dividends and growth throughout bull and bear markets for consistent long-term passive income. If you're hoping to build wealth and earn passive income, chances are you've come across dividend ETFs like SCHD, VYM, and DGRO. But with so many options, how do you know which one is best for you, especially when the market goes up or down? Today, we'll break down how SCHD, VYM, and DGRO perform in different market conditions. We'll look at their dividend reliability, growth potential, and consistency, so you can make an informed choice for your portfolio. Before we dive in, remember, this video is for educational purposes only and is not financial advice. Always do your own research before investing. Let's start by laying the groundwork. Why does it matter how these ETFs perform in different market conditions? Well, markets don't move in a straight line. Bull markets can last years, but so can bear markets or sideways periods. Choosing an ETF that delivers reliable dividends and steady growth, even when things get tough, can help you sleep better at night and stick with your plan for the long haul. So, what makes SCHD, VYM, and DGRO so popular for dividend investors? Let's introduce each one briefly. SCHD stands for the Schwab U.S. Dividend Equity ETF. It focuses on quality companies with a strong history of paying and growing dividends. VYM is the Vanguard High Dividend Yield ETF. It tracks an index of high-yielding U.S. stocks, emphasizing current income. DGRO is the iShares Core Dividend Growth ETF. It targets companies with a consistent record of growing their dividends year after year. Each ETF has a unique approach to dividends, which can impact how it performs when markets are strong, weak, or somewhere in between. Let's break things down into three key areas: dividend yield and stability, total return in bull and bear markets, and diversification. First up, dividend yield and stability. Dividend yield measures how much income you get from an investment, shown as a percentage of the price. For example, if an ETF pays $3 per share in dividends each year and its share price is $100, the yield is 3%. A higher yield means more income, but sometimes it comes with more risk. SCHD usually offers a yield between 3 and 4%. It focuses on companies with strong financials and a track record of 10 years or more of paying dividends. This focus on quality means SCHD's dividends are generally reliable, even during tough times. VYM often has a similar yield, sometimes even a bit higher, because it includes more high-yielding companies. However, some of these companies might not have the same consistent dividend growth as those in SCHD. In rough markets, VYM's yield may look attractive, but the stability can depend on the health of specific sectors like energy or financials. DGRO, on the other hand, has a slightly lower yield, usually between 2 and 3%. That's because it focuses more on companies that grow their dividends, not just pay high dividends right now. Over time, this growth can add up, especially if you're reinvesting those dividends. One more important term, payout ratio. This tells you how much of a company's earnings go to dividends. A lower payout ratio usually means the dividend is safer, since the company keeps more cash for tough times. SCHD and DGRO tend to hold companies with moderate payout ratios, while VYM can include some with higher ratios, which could be riskier if profits fall. So, if you value steady and growing dividends, SCHD and DGRO focus on quality and sustainability. VYM may offer higher yields, but with a bit more risk in challenging markets. Let's move to the second point, total return in bull and bear markets. Total return combines two things, price appreciation and dividends. In other words, how much your investment grows, including both rising share prices and income from dividends. In bull markets, when stocks are rising, all three ETFs tend to do well. SCHD and DGRO can shine here, because many of their holdings are strong companies that not only pay dividends, but also grow fast. For example, from 2013 through 2021, a long bull market, SCHD delivered an average annual return of around 15%, including dividends. DGRO was close behind, while VYM trailed slightly due to its focus on higher-yielding, sometimes slower-growing companies. What about bear markets? Let's look at 2022, when stocks dropped. SCHD held up better than VYM, thanks to its quality screens. It avoided some of the riskiest, most volatile companies. DGRO also performed relatively well, as companies that grow their dividends often have stable businesses with strong balance sheets. VYM, with its tilt toward higher yield sectors, can be more affected when those sectors struggle, like banks during financial crises or energy companies when oil prices collapse. Here's the key takeaway. In bull markets, all three ETFs can give you growth and income. In bear markets, SCHD and DGRO have shown more resilience, while VYM's higher yield can come with a bumpier ride. Now let's talk about diversification and why it matters. Diversification simply means not putting all your eggs in one basket. A diversified ETF spreads your money across many companies and industries, reducing the risk that any one stock or sector will drag down your returns. SCHD holds about 100 companies, with its largest positions often in sectors like technology, healthcare, and consumer staples. Its quality screens help avoid companies with shaky finances. However, it's a bit more concentrated than the others, so it can be more sensitive to swings in its top holdings. VYM is more diversified, holding over 400 stocks. It has broader exposure to sectors like financials, consumer goods, and energy. This broad reach can help smooth out some bumps, but it also means VYM is more exposed to sector downturns, especially if high-yield sectors are under pressure. DGRO typically holds around 400 stocks as well. Its focus on dividend growth means it includes companies from a wider range of industries, and it avoids those that pay out more than 75% of their earnings as dividends. This helps ensure the companies can keep growing their payouts, even in tough times. So SCHD is a bit more focused, but very high quality. VYM and DGRO are broader, with DGRO emphasizing consistent growth and VYM emphasizing higher yields. Let's bring this all together with a quick recap. If your main goal is reliable, growing dividends with a focus on quality, SCHD and DGRO are strong contenders. SCHD tends to offer a higher yield with strict quality screens, while DGRO leans toward companies that steadily increase their payouts, even if the yield is a bit lower. If you're seeking higher income right now and are willing to accept a bit more risk, VYM might appeal to you. Its broader diversification can help, but be aware of its exposure to sectors that may be more volatile in certain markets. None of these ETFs is perfect for every situation. The best choice depends on your personal goals, risk tolerance, and time horizon. Remember, dividend investing is a marathon, not a sprint. Consistency matters more than chasing the highest yield. And whether the market is roaring or stumbling, focusing on quality and long-term growth can help you ride out the storm. If you found this breakdown helpful, please consider liking this video and subscribing to the channel for more clear, educational content on dividend investing. If you have questions or want to share your experience with these ETFs, let us know in the comments below. Thanks for watching and happy investing.